Well, inflation has slowed more than expected, slipping back within the Reserve Bank's target range of 3 to 6%. Statistics South Africa says consumer inflation dropped to 5.3% year-on-year in April from 6.1% in March. Several items, such as food and beverages and transport, were less costly in April than in March. The Consumer Price Index, or CPI, is the key measure for inflation used by the Reserve Bank when deciding on interest rates. The bank is largely expected to stay away from rate hikes in the medium term, but will only cut rates if inflation risks diminish further.
Forecasts are that inflation will now stay inside the target range throughout the forecast period. That doesn't necessarily mean that the Reserve Bank can act on that, because I think the forecast risks are still extremely high, specifically related to the rand. So in terms of the Reserve Bank's forecasts, I believe that the SARB will probably lower its inflation forecast, but this is a bit of a dilemma for the Reserve Bank. Under normal circumstances, without very high forecast risk, we think that there could have been an opportunity for the SARB to cut, but I think that the currency risk is at this stage so high, both from domestic and global factors, that the SARB will just have to wait and have more certainty about that medium-term inflation outlook before it can even consider cutting interest rates.
At the same time, the rand has firmed, dipping below 13 rand against the US dollar. It last hit this level around the 24th of April. This follows the release of the better-than-expected consumer price inflation data. The rand had been strengthening ahead of the release of the data, which comes on the eve of the Reserve Bank's monetary policy decision. The local market doesn't expect the bank to move rates, with the current repo rate of 7% expected to remain unchanged.